Welcome to the monthly economic update. I'm joined today by Bob Caneen, Senior Economist. Many thanks for your time today, Bob.
Thanks for the opportunity, Jason.
You know, it's been a really frenetic 3 weeks in markets, particularly since Donald Trump entered the Oval Office. We've seen executive orders issued for the building of a wall with Mexico. We've seen an executive order issued that bans travellers from 7 countries into the US. We've seen a foreign policy debate on Twitter with Germany, with Japan, with China, and we've also seen a tussle with our own Prime Minister over the phone. So what should investors make of all this, Bob?
It has been an extraordinary 3 weeks, and investors are wrestling with what is Donald Trump's actual economic policy and what are his negotiating tactics. Now, the perceptions are there is a good Trump in the sense of lower corporate taxes and higher infrastructure spending, and therefore generating stronger US economic growth. Against that is the perception that there may be a bad Trump or a troubling Trump in the sense of building walls and imposing border adjustment taxes, and this potentially will damage global trading relationships.
Well, it seems that the market is seeing the good Trump at the moment. We've seen a return of the January effect this month. What has been the impact on global markets?
Well, global markets made mild gains in local currency terms in January, but this is largely on the back of the American share market making record highs. So the American shares are being driven by these positive perceptions that lower corporate taxes, higher infrastructure spending are good for American corporate profits. Against that, European and Japanese share markets actually weakened in January. So they're concerned about Donald Trump's trade rhetoric and potentially the loss of exports to America.
Okay, and how do you see the US economy's health at the moment?
The American economy is doing reasonably well. We're seeing very solid job gains, unemployment rates below 5%, encouraging business and consumer sentiment surveys, strong retail spending. So the American economy is doing particularly well. Against that is the fact that inflation pressures are building. So wage pressures in particular are rising, and that brings with it inflation risks. So the Federal Reserve, the American central bank, is actually contemplating raising interest rates again this year.
That's a good point. And how many interest rate rises do you think are priced into the market from the Fed at the moment?
Well, there's an interesting difference between the market's view of interest rates, where they're seeing the potential for a 0.5% or 2.25% moves this year. Against that, in contrast, the Federal Reserve's own interest rate projection sees interest rates move up by 0.75%. So there's a 0.25% difference between the two.
So do you think there could be a shift in focus over the next few months from the US to Europe, particularly if President Trump's Twitter account goes quiet, as it has for the last 24 hours? And particularly given that some of the peripheral banks in Europe are not as healthy as they should be?
The European financial system is still fragile, and in particular Italian banks, they've got very high non-performing loans. They need to raise capital. So that is still a long-term concern in terms of financial stability in Europe. So we need to watch that. As well, political risks may become very prominent in Europe this year because we've got some important elections this year.
Okay, let's focus on Australia for a second. It certainly doesn't appear that there was a strong January effect in Australia this month.
No, actually Australian shares disappointed in January. They fell by minus 0.8%. So some of the interest rate sensitive sectors such as property trusts and the consumer discretionary sector actually disappointed in January. However, we did see some strong gains for the metals and mining sector. And that's primarily due to stronger commodity prices. So we saw very healthy gains for the iron ore price. That, in a way, boosted the Australian dollar. So the Australian dollar moved sharply higher. And for global share investors with an unhedged portfolio, they actually saw negative returns because of the stronger Australian dollar.
So our last quarter GDP print was minus 0.5. If we receive another negative GDP print in the upcoming quarter, then we'll see the first technical recession in Australia for well over 20 years. Do you see that as a possibility?
Well, we see it as a low chance at the moment. When you have a recession, technically it occurs when you have 2 consecutive quarters where the economy contracts. Now, the September quarter was an extraordinary number, minus 0.5%, and we had quite a few temporary factors involved. What we've seen so far in the December quarter, we're seeing some solid job gains, encouraging that business survey. Retail spending has held up better. So from that perspective, that indicates it's a very low chance we'll get another negative GDP number.
Okay, well that's good news. But how do you think the RBA will manage things from here?
Well, the Reserve Bank looks like it's going to be on hold with interest rates at 1.5% over coming months. Now, the Reserve Bank is balancing the inflation economic activity story. So inflation is running itself at 1.5%. So it's still low, it's still below the Reserve Bank's target of 2 to 3%. But against that, what we're seeing, apart from more positive December quarter data, we're also seeing very strong gains in house prices, particularly in the Sydney, Melbourne market. So the Reserve Bank's going to be conscious of those asset price moves.
Okay, and finally, what are the key issues that investors should be aware of over the coming months?
Well, obviously we're going to have to be very conscious of Donald Trump and Twitter. We also have to be concerned a little about what's happening in Europe in terms of political risks. So we've got a Dutch election in March, a French presidential election in April, May, and a German election this year. So the concern there is potentially there are some risks to the European Union, maybe a repeat of Brexit if some nations see populist vote rise.
Well, Marine Le Pen came out this week and reiterated that she would leave the euro if she was elected, so that in itself is worrying.
That is a concern, that if Marine Le Pen becomes the French president, obviously that she potentially could take France out of the European Union, and France is a key core member of that union, so that would be very problematic.
Well, many thanks for your time, Bob. Great to talk to you.
Thank you, Jason.